Welcome to this next educational video in a series where we're going to be talking about the two myths of the stock market where riding it out is okay and you get a 10% return. Those two are myths, and today we're going to bust them. I'm going to share a screen with you. I'm going to talk about the history of the stock market, how it's performed, and where we are today. But first, I'm Robert Martin. I'm a chartered financial consultant, and I'm also a partner here at Zenith Retirement Planning. With that said, let's get into it. So in our industry, when we use the term stock market, we refer to either the S&P 500 or the Dow Jones, maybe even the NASDAQ. The stock market's a collection of stocks that trades openly to us all. Now, when people say the stock market collapsed, they're usually referring to an index. And the index that we're going to use for today's example is the S&P 500. And usually, if you're investing in the stock market, you could be in a portfolio of hand-picked stocks, or even bonds, or a variety of other things. But what I've seen in most portfolios that were made for future retirees, people that weren't retired yet and they were still accumulating assets, they either use target date funds or they use investment instruments that track an index. For example, tracking the S&P 500 would mean that when the market goes up, you would also go up. If it goes down, you would also go down. So if we take a look back to 2000, January of 2000, the S&P 500 was worth about $14.69. Okay, and all these numbers today are not based on inflation. That's why they're going to be a little bit off. But it started at $14.69. Then because of the dot-com crash, where there were a ton of overvalued internet stocks, the S&P 500 went down 50%. 50%. How much do you think you need to earn to make that back? Do you think it's also 50%? Well, unfortunately, if the stock market goes down 50%, you need an additional 100% to make your money back. And this goes for any investment. And so that's what happened. Between 2002 and 2008, we saw a climb back to where we were finally worth the same amount we were worth in 2000. But then we also got hit with something else, and this was the crash of 2008, where there was a ton of growth for predatory mortgage lending, unregulated markets, massive consumer debt, even some toxic assets. And then, of course, when we called it the housing bubble of 2008, there was a collapse of home prices. And so we dropped another 50% at that time. But then we made it back 100%. By 2013, we were back at where we were at in 2008 and where we were at in 2000. In fact, in 2013, the S&P 500 was worth $14.69. In the year 2000, the S&P was worth $14.69. So over 13 years, there was a 0% rate of return. And this is not including fees. And so if you were saving for retirement during that time or working or you were investing and you saw this and your money was still going up, it's likely because you were invested in something else or you were still contributing money at that time. So your money was still going to go up. But here's the thing. The S&P 500 is in fact worth much higher today. On December 31st of 2020, which was a couple years ago, we were at 3,765. In 2000, we were at 1469. So if we look at the math, where you started as an investor, if you were tracking the S&P 500 or the stock market, and you ended up at 3,765, you'd be at about 4.5%. Now, when we consider riding out the stock market, what we need to consider is during that period of time where we made 4.5%, the stock market also had two major collapses. Can you imagine if you were also taking money from your portfolio during this time? It could have been much, much worse. And for many millions of Americans, it was worse. It was much worse. If I return now to riding it out and getting 4.5%, the question that you might ask is, well, is it worth it to go through two of these pits while riding out the market and only make 4.5%? Well, we've all done it to some extent. Whether you have 20% equities in your portfolio and you have some exposure there to the S&P 500, or if you have a stock portfolio and 80% of your money's in stocks, there's a good chance one of those stocks is probably in the S&P 500, if not a good majority of them. And so the myth, getting a 10% return, is actually not true, particularly in the last 20 years, where you've only made 4.5%. You may have seen more because you were contributing money or because you were invested otherwise. So as an investor who needs to rely on the stock market definitely returns over time, and writing it out can be helpful, especially if you're not taking income from your money. But if you're taking income from your money, I encourage you to have a well-diversified portfolio, have some cash sitting, so that if the market does go down, you don't have to rush to get income from it out of fear that maybe your portfolio will be worth less afterwards. Instead, you could take from your cash, from your savings. Having the right strategy like that is very important. And I think also setting the correct expectations for the stock market is equally as important. If you expect the stock market to perform and give you 10%, but it's only did 4.5%, that's a sign that maybe your expectations should be adjusted a little bit. So you're not disappointing yourself. So you're not feeling bad. So you don't have to second guess the performance of your portfolio. And you know what you can expect, and you know what your portfolio can handle, and you have a well-diversified portfolio, then you're in good hands. Folks, if you enjoyed the video, please give us a thumbs up. If not, give us a thumbs down. Regardless, please subscribe so you can see our future content. Very happy to be helping y'all, and have a great day.